The stock market is currently closed, and as of the final bell on Friday, June 19, 2026, BigBear.ai Holdings opened its session at $3.92, experiencing sharp intraday fluctuations between a low of $3.76 and a high of $3.94, before officially settling the day at $3.92 per share, with an intense trading volume exceeding 34 million shares moving across the floor. While the broader public often focuses on massive trillion-dollar entities to gauge the health of software automation markets, a quiet shift in institutional capital allocations suggests that smaller, specialized intelligence names are facing a completely different set of structural demands that retail traders rarely notice on their standard tracking screens. The immediate assumption among retail participants tracking asset sheets via their Robinhood app or executing trades through automated tools is that small-cap software providers will automatically rise on the coattails of larger microchip giants. Yet the hidden reality governing this specific asset centers on a complex backlog conversion cycle that is moving far slower than public optimism predicts. Institutional traders are not purchasing this equity based on social media trends or casual internet hype. Instead, they are looking deeply at government procurement structural timelines and specialized defense clearance layers that dictate exactly when a contract turns from a verbal agreement into actual recognized revenue. This structural divergence creates a massive delta between what casual retail buyers expect to happen over a weekend and what prime government contractors experience over a multi-year operational window. The general consensus among individuals utilizing mainstream investing sites is that any corporation tethered to advanced predictive data modeling should exhibit exponential top-line expansion, especially given the historical upside performance seen in sector leaders like Nvidia stock or even macro-technological shifts reflected in Apple stock and Tesla stock. Investors utilizing self-investing strategies look at these massive benchmarks and mistakenly apply the same growth metrics to boutique military and enterprise analytics firms, expecting immediate scaling. The reality challenging this common belief is that enterprise software adoption within federal agencies requires navigating dense bureaucratic frameworks, intensive security protocols, and rigid budget cycles that cannot be bypassed by clever marketing or software updates. When someone opens an individual brokerage account to allocate capital toward volatile small caps, they are frequently met with the realization that engineering backlogs do not instantly translate into bottom-line profits, creating a situation where the underlying corporate financials frequently contrast with sector narratives. When we study the recent market swings and technical momentum of BigBear.ai over the past few weeks, the intensity of its trading volume becomes a central focal point for anyone looking for technical clarity. Dropping from a brief high near $5.46 down toward support levels close to $3.01 earlier in the cycle shows a security that is caught in a fierce tug-of-war between momentum-driven retail traders and risk-averse institutional asset managers. High-volume days exceeding 34 million shares indicate substantial liquidity shifting hands, which often happens when larger funds rebalance their algorithmic models or adjust their exposure to high-beta components within specialized technology indexes. Retail traders participating in Robinhood stock trading or using the SoFi trading platform often provide the necessary liquidity for these massive institutional shifts, buying into positive sentiment waves while larger accounts slowly distribute shares to manage their overall risk profiles. This heavy volume without a sustained upward breakout demonstrates that every surge in buying pressure is being actively met by structural institutional selling, indicating that sophisticated market participants are capping the upside until clear, unmanipulated operational metrics show structural improvement. Macroeconomic pressures have added another layer of friction to this setup, as persistent high interest rates continue to change how institutional managers evaluate non-profitable growth entities. When capital was virtually free, public markets were highly forgiving of software firms burning through reserves to fund expansion, but the current environment demands clear paths towards positive net income and self-sustaining operations. Analysts reviewing corporate profiles across various online investment networks recognize that firms without positive cash flow are highly sensitive to credit market tightening, which directly influences their valuation multiples. For an investor utilizing an Interactive Brokers account or managing their retirement setups through specialized Fidelity IRAs, comparing a capital-intensive, long-cycle software firm against highly liquid software-as-a-service business models highlights the structural challenges specific to this company. The cost of carrying debt and the dilutive nature of secondary share offerings mean that small-scale intelligence providers must execute their current contracts flawlessly to avoid returning to public markets for expensive operational funding. This shifting landscape forces individual operators using various Interactive Brokers trading setups to think about the differences between holding highly stable, dividend-paying companies and managing highly speculative equity structures.
When retail accounts explore automated wealth management options like Schwab Intelligent Portfolios or use a specialized intelligent portfolio framework, they are generally steered towards diversified baskets that balance high-risk entities with defensive assets to mitigate sudden drawdowns. However, for those engaged in aggressive online investing via active individual accounts, understanding the microstructural mechanics of a stock like this one becomes a necessity. The daily price discovery mechanism for small-cap technology equities is heavily influenced by options clearinghouses, market maker hedging activities, and short-term derivative flows that often create artificial price expansions or sudden, unprovoked washouts that have very little to do with the actual underlying enterprise performance on that specific afternoon. To better understand how this equity responds to sector-wide trends, it is useful to look at the broader behavioral shifts taking place across major consumer retail networks. For instance, active participants using the popular SoFi investing app or tracking technical indicators on a Fidelity trading platform often look for correlations between mid-tier data firms and foundational tech giants. When major corporations announce massive cloud infrastructure investments, it creates a temporary wave of optimism that lifts the entire sector, leading retail traders to increase their positions in fractional shares or high-leverage options contract vehicles. This speculative buying often creates a temporary disconnect between the company's real-world enterprise value and its immediate stock market valuation, leaving late-stage buyers vulnerable to sudden retracements when the macro enthusiasm inevitably cools down and the market returns its focus to actual quarterly performance metrics. At this point in our analysis, it is essential to look directly at the community sentiment surrounding the security to gauge where retail positioning stands relative to institutional flow. Comment below how many shares of BigBear.ai you currently hold in your portfolio, and specify whether you are managing this position through a traditional long-term retirement account or actively trading it on a short-term basis. Gathering this data from real-world accounts helps clarify whether retail liquidity is continuing to accumulate shares at these current support levels, or if individual participants are beginning to rotate their capital into more stable technology alternatives. To evaluate the core stability of this enterprise, we must look beyond daily ticker fluctuations and examine exactly what the business model entails and how it generates its core revenue streams. BigBear.ai operates primarily as a provider of operational artificial intelligence, machine learning, and advanced predictive analytics solutions tailored for complex defense frameworks, national security operations, and intricate supply chain logistics software. The firm builds modular data processing tools designed to ingest massive streams of unorganized information, synthesize disparate datasets, and provide actionable real-time decisions for complex environments where human processing speed falls short. A substantial portion of their historical revenue model relies on long-term federal defense contracts, acting either as a direct prime contractor or a specialized subcontractor for larger aerospace and defense conglomerates that require precise data engineering capabilities. This corporate structure was heavily accelerated through its historical merger with a special purpose acquisition company, a structural path that injected immediate capital but also brought intense public market scrutiny and immediate structural demands for rapid profitability that long-cycle defense contractors often struggle to meet in their initial years of public listing. Reviewing past financial reports shows a persistent pattern where engineering expenses and high administrative costs have consistently outpaced incoming contract revenues, leading to sustained operational losses that continue to pressure the balance sheet. While contract wins with the United States Army or specialized aviation authorities look impressive in headlines published across online investing sites, the actual margin distribution reveals that the cost of delivering these custom software solutions leaves very little room for net profit. Investors utilizing a Fidelity brokerage account or analyzing fundamentals via the Interactive Brokers platform can see that the company's operating profit margin has remained deeply negative over consecutive quarters, forcing management to constantly balance cost-cutting measures with the necessity of retaining highly paid security-cleared data engineers. This balance sheet reality is precisely why the stock experiences dramatic corrections whenever an earnings report fails to show a clear reduction in cash burn or a significant acceleration in unbilled receivables conversion. Looking toward the future, the outlook for this security will be entirely defined by the tension between market expectations and operational reality over the coming quarters. The market currently expects that increasing global defense budgets and heightened focus on automated warfare tools will automatically translate into highly lucrative, high-margin software contracts for the company. If reality matches or exceeds this expectation through the securing of multi-year fixed-price prime contracts that expand gross margins, the stock could find the necessary structural support to break out of its current depressed trading range and reward patient long-term holders. However, if reality reveals that federal budget reallocations favor physical hardware over boutique software modules, or if contract implementation delays continue to prolong the company's cash negative state, the stock risks breaking down past its historical support levels, potentially forcing further equity dilution that would harm existing retail shareholders. When evaluating how to approach this asset within a modern portfolio, participants must carefully weigh these future scenarios against their own personal risk tolerances and structural investment horizons. Those utilizing self-investing frameworks through a Robinhood app or managing tailored selections via SoFi Active Investing need to recognize that small-cap defense software remains one of the most volatile subsectors in the public markets today. Unlike stable software entities that generate predictable recurring revenue from millions of commercial users, a firm that relies on a concentrated group of government clients faces unpredictable regulatory pivots, political funding disputes, and sudden contract terminations that can alter the long-term valuation model in a matter of hours. Therefore, relying purely on generalized investment enthusiasm without verifying contract execution structures can lead to significant capital misalignment. In summary, the core insights surrounding BigBear.ai highlight a massive contrast between the optimistic retail narrative and the cold operational parameters governing the business. While casual observers on various investing sites look at the company as an accessible entry point into the broader data intelligence trend, the technical reality marked by the closing price of $3.92 on June 19, 2026, reflects a market that remains highly skeptical of the firm's immediate path to real profitability. The massive 34 million share trading volume underscores the intense institutional rebalancing and liquidity preservation efforts taking place behind the scenes, far away from the simplified perspectives found on standard social media feeds. Ultimately, the survival and future valuation of the enterprise will depend not on sector-wide momentum or correlation with larger tech benchmarks, but on management's concrete ability to turn its extensive backlog into positive net cash flow before its existing cash reserves are depleted. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice.